Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Hit that subscribe button for the latest market insights. Well, this week on Wall Street, we're seeing a continuation of this quarter's impressive rally with the S&P 500, the Dow Jones, and even the Nasdaq all pushing upwards. And despite a slight retreat earlier in the week, optimism remains quite high, especially with analysts lifting their S&P 500 targets. So here's the rundown. Economic indicators are making headlines once again, from durable goods bouncing back to the latest uptick in home prices, and of course, a dip in consumer confidence. But all eyes are on Friday's big reveal, the PCE price index, the favored inflation gauge of the Fed. Now, that, of course, is a measure of the spending on the goods and the services by the people of the United States. And we're also keeping a keen eye on the markets, assessing the potential for a shakeup and spotlighting sectors that are just heating up. Joining us is financial expert Bill Baruch, president of Blue Line Futures. Bill, thanks for coming on the show and breaking this all down with us today.
Thanks for having me on. Financial expert. I love the intro. Thank you.
Yeah, I got to enlighten the audience a little bit. I mean, you got a lot of history in trading. You run a big fund. Let's talk a little bit about this rally, the S&P 500 continuing its rally. I'm curious what's driving the momentum. Obviously, we've seen the market price in some Fed cuts here, but do you see this trend persisting through the quarter?
Yeah, I think we came out of the Fed meeting and I think the market got everything it wanted to see for now. And really what that was keeping, for me as a trader, what I was looking for, and I think the market obviously responded as it was looking for too, was them keeping the dots signaling 3 cuts in 2024. If you go back to December of 2023, they had 3 dots on there, or 3 cuts lined up with the dot plot. I mean, and the market quickly started pricing in 6 cuts. The market spent a good month and a half, 2.5 months or so, pricing out 6 cuts and aligning itself with the Fed. So now that it was finally aligned with the Fed going into that meeting, we didn't want to see the Fed become more hawkish than that. So the fact that they left those cuts on there, given from the dot plot, I think the market reacted with a sigh of relief. And then as we went into the Federal Reserve conference with Chair Powell, he was pretty, confident that inflation was moving towards that 2% target, confident and a bit that January and February could be seasonal factors, lifting inflation then. So I think the market got really everything it wanted. But at the end of the day, they did raise their forecast for inflation this year, their forecast for growth. They lowered their unemployment forecast. So there was little bit of hawkishness in there. So if I take a step back and say, okay, we had this big move post-meeting, it would make sense for the market to sort of digest it now. And then do we hear any hawkish comments from Fed members? I think about it from the sort of Jekyll and Hyde effect, where you hear one thing and then maybe it's reined in a little bit, hear something else in the coming weeks. So I am a little cautious just at these levels, though we remain very, very allocated in our wealth portfolios. But I think it's time to take a step back and just at least have a bit of caution as we move forward for the next 2 months.
Yeah, a little bit of good cop, bad cop. I'm curious. I know that they took away 1 cut for next year. So some of this data is starting to come in and we're digesting it. What are some potential catalysts or maybe some headwinds for the S&P 500 reaching those new highs, even higher than we've gotten here?
Well, we've had really pretty stellar earnings overall. I mean,
right.
You look at it most recently last week, Nike and Lululemon, consumer discretionary names. But overall, I mean, tech has done very, very well. You see a name like Micron with blowout earnings kind of just really kind of falls within that realm of Nvidia and partnerships with Nvidia. So there's definitely leadership in that sense in the market, and that's important. But as we move into Q2 earnings here from Q1 in taking place in April, you got to wonder, do any of these companies start reining in some expectations? That could be something cyclically, and looking from an analysis going back to the October 2022 low. I do believe that this is a bull market through October 2027. But there's going to be sort of Cyclo-tops, and I think April, May could be, something where the market cools off a bit. Now, I'm not trying to scare anybody. Basically, what I'm saying is we've taken off, like an airplane would, and it may be time to sort of level out a little bit. And I think that's something that you got to be looking for just seasonally as well. So I think it's just a line for taking a bit of caution right now as we move into the next couple of months. Now, outside of that, the U.S. dollar, I would be fearful to see some U.S. dollar strength if the Fed were to be a bit more hawkish, and that could be, it's a negative it's a negative correlation with the equity markets. If that U.S. dollar strengthens, it's something to be cautious about.
Yeah, has anything surprised you here? I mean, we've seen a bounce back in durable goods and the uptick in home prices, but yet, consumers are spending less here. So what are we looking at? What's the outlook?
Well, I would have to say that Fed Chair Powell, in his comments, he has to feel confident that the economy is moving at a trajectory or a pace that he would expect in order for him to say what he's saying. Yeah, we are in an election year right now. And I would imagine that they're trying to keep everything really cohesive, within the administration right now. And there may be a bit more, talking from the Fed in politically than maybe people may sometimes imagine. But I also believe the Fed is watching the stock market a lot less than people believe too. So we kind of factor both of those sides. Fed Chair Powell, he may be looking at the trajectory of consumer spending, maybe worrisome of unemployment, maybe coming up a bit more. I think that was a catalyst in the Q4 that some of the Fed members were looking at unemployment and the movement of unemployment rate off of the lows can sort of be a canary in the coal mine for a slowing economy. So that's something I'm sure they're keeping a very close pulse on, but it's very distorted. I mean, you with many immigrants getting jobs here in the U.S. and right. I think post-pandemic distortions as well. It's a lot of the data has to be taken with a grain of salt, especially the initial jobless claims from week to week and the non-farm payroll hires, especially with all the government spending month to month. So they must see something here that I think is saying the economy could be slowing, or there's signs that it should be slowing. So looking about that, taking everything I just said as well, inflation, January and February were a bit higher than expected, but those are just two numbers. 3 is a trend. So I think the next month, it leads into the May meeting very, very well. Now, we don't expect a cut in May, but I think we'll have a lot of answers in the next 60 days.
Yeah, no, interesting. I mean, we talked a little bit about it off the top, too. We have the PCE coming out on Friday, more economic data. It seems like the Fed likes this one. What are your expectations? And, how does the Fed respond to these inflationary measures that you talked about?
Yeah, the PCE number, markets are going to be closed. I mean, here in the U.S., markets are going to be totally closed. Usually, we've had non-farm payroll on Good Friday before, and you get a little bit of holiday hour opening for that. We've seen some great volatility during those hours, but this time the market is closed for the PCE.
They're hiding it.
Yeah, they're going to. It's going to be an interesting Sunday open. I'll tell you that on Easter. But really, I think overall, you see little volatility in this number typically. We've seen it now decisively kind of hanging below 3%. They're looking for about 2.8 again, and even softer in this current month of March, which would be released in April. So I think overall, I think inflation trajectory is moving the right way. If it comes out in line with expectations, we have been seeing more of a relief. I think for PCE a month ago, when that came out at the end of February for January, that it wasn't as hot as the CPI numbers, and we've been able to see some relief in risk assets after that. So if we see something in line here Friday, maybe we get a little bit of a risk-on rally Sunday night into Monday.
Yeah, no, it's going to be interesting. Obviously, we'll have coverage at Kitco News on the PCE numbers too. We talked a little bit off camera about some sectors that are maybe taking a little bit of a breath here, some that are heating up. Where do you see some investment opportunities here in this market where we see greens across the board?
Yeah, for us, we're going to start with futures and kind of looking at that real quick and commodities. Now, I do think we're in a secular bull market of commodities. I mean, look at some of the softs, look at cocoa and sugar. Some of them have done some really well. So people may not be paying attention to those. Get those on your radar. I wouldn't be chasing anything, but I mean, if we could be in a secular bull market, you see what's happening there. And what does that mean for other commodities? I think we could start to see agriculture markets turn a bit. We could also see, the gold has set a record high. Some of the other metals that have been really lagging could start to show up. Now, this doesn't mean tomorrow and you need to go buy commodities, but I think overall over this year, and I was just a moment ago was talking about maybe some dollar strength. It would be interesting to see if the dollar does strengthen and move up a bit. But when it starts to pull off of whatever rally that may happen over the next couple of weeks, we could see some serious rallies in commodities. And what does that mean for me on the equity side? I mean, I think energy is to continue to do well. You look at, just crude oil got above $80, but energy names have done and really performed. We're very overweight energy relative to the benchmarks, holding about 10% energy. and the benchmark of the S&P is about 2%. We're really leaning into the refiners, Marathon Petroleum. We've added Phillips 66, more refining exposure, and the refinery margins have held up really well. But we're not just a commodity-focused company on the advisor side. I mean, we've been very overweight tech, with our top holdings being Amazon, Nvidia, Alphabet, and Micron, and then Synopsys below that. But one thing we've been doing is dialing back that exposure a bit as we've really kind of rallied very strongly over the past several months, kind of making some rotations under the surface. We've been over 50% tech. We're closer to just about 40% now, and sort of doing some rotations into those material names, a little more Southern Copper exposure, like I mentioned, those refineries. So there's some things to do here within this bull rally that can help you outperform. That's kind of what our focus is, thematic rotations.
Yeah, interesting. I mean, we saw cocoa hit $9,000, bypass and surpass copper, which is quite crazy too. Talk to me a little bit on the equity side. I mean, you're obviously bullish on the oil and gas side, the energy. Talk a little bit more about tech. I mean, the Magnificent Seven, we've seen them pull back a little bit. Are they over-evaluated here? Are you following other stories outside of these big guys?
I mean, it continues to be a story of Nvidia and then those who are partnering around Nvidia. I mean, they put out a tremendous report. I mean, my job is to manage risk, and it's been a top holding of ours. I've had to trim that thing a couple times just to keep it relative, a good managed value in our portfolios. I mean, we trimmed it ahead of earnings, thinking that maybe even if they had a good earnings report, it would maybe couldn't react very strongly. And I tell you, they blew the doors off, and we actually added to it and increased it back up to one of the top holdings of ours. But it's not just Nvidia. There's names around it, like Synopsys does electronic design automation, and so the more money that Nvidia gets from these hyperscalers, from Microsoft monetizing AI, Meta, Facebook, Alphabet, Apple monetizing it. As these companies monetize AI and need more GPUs, they're spending more money with NVIDIA. And what that means is those around NVIDIA will lift those boats too. So Synopsys, you'll see with Micron, so the high bandwidth memory, Micron is just not just now with NVIDIA, but we're talking about some of a very cyclical business with memory demand. And they were talking about memory demand troughing over a year ago. So we're actually seeing that pay dividends now. So there's a lot of really good stories. And what I will finish with saying, without getting too much into the weeds here, what I will say is you look out the earnings expectations. I mean, some of these names are trading up 40 and 50 multiples now, but you go out to 2026, I mean, these multiples are in the mid-20s now. So imagine we keep getting, there are pricing in higher revenues. But I would imagine that I think that there's definitely still room here as they meet these revenues, and the trend has been exceeding and raising expectations. So if we continue to see that, there's definitely like that more cyclical bull market through 2027. Now, I wouldn't be surprised again that we have a bit of a breather at one point where maybe some expectations are brought back. And if that happens, it could really set the stage for the next leg of the rally after that little bit of a leveling out.
So you're picking up some of the picks and shovels around Nvidia. I'm curious, you just talked about this little breath. If it happens as you suggested, how do investors prepare for this potential pullback here? I mean, should we be looking at our portfolios and rebalancing now? What are your suggestions?
Well, that's what I've been doing. Is I've been monetizing some tech. Really, maybe it's reducing names. Recently I've reduced Apple and AMD. I cut Adobe altogether. Things like that, just that I can raise cash. But overall, I'm buying a little bit of a cushion with SPY puts in portfolios that go out to the end of May, and we're spending just 0.5%. And I may add to that. So just try to build cushions. Now, I'm not trying to scare people. That's not my goal at all. And I'm not sitting here scared either. I think, again, it's just more of a leveling out a little bit, more of a healthy consolidation and digestion. But again, at the same time, we're only about 3% cash. I would like to continue to raise a bit more cash if we keep going higher and just kind of, manage this with, my expectations for gains from here, are not what they were in January. So I think if you look at it from that point of view, consolidation and a leveling out could then lay the groundwork to finish the year higher, and being able to capitalize on a pullback and put more cash to work upon a pullback would be the way to be. I'm looking to capitalize here, not really be fearful.
Yeah, absolutely. A little bit of profit taking never hurt nobody. Bill Baruch joining us from Chicago, president of Blue Line Futures. Thanks again for coming on today, and happy birthday to your little girl.
Thank you very much.
Thanks, Bill. I'm Jeremy Szafron for Kitco News. Thanks again for watching. Don't forget to subscribe to our YouTube channel and like that little video. We'll see you next time.